get a loan application. And then what I think is the best thing to do is to run numbers on 4 or 5 different properties for them, different price ranges, show them cash to close, show them what their monthly payment's going to be. Because if people like haven't seen numbers before, then they haven't had time to digest the data. Then if they have had time and they're comfortable, then they can move quickly. And that's going to help them be more successful in a multiple offer situation.
Hey, buddy.
Hey, man.
Good to see you.
Thanks for having me.
I'm glad you could make it. When I think of you, I think of my James Bond analogy. James Bond walks into a restaurant. He sees all the hairline. I'm sorry. Damn it! He sees all the exits because he knows how to escape. So I walk into a restaurant and I see hairlines like that. That's a good head. That's a good head of hair. Is that a turkey visit?
No, it's not.
It's all
It's
natural.
all natural. That's all me. I had nothing to do with it.
Must be nice.
It's weird. My mom's father's bald his entire life.
Really?
Yeah.
Hey, it's good to have you on.
Thanks, man.
I know you got into golf lately. You're a great athlete, but you're a horrible golfer.
Yeah. Good loan officer, bad golfer.
Yes, exactly.
Yeah.
But I won't get into that too much.
Thank you. I appreciate that.
One thing I think is really interesting, I remember you telling me one day, I won't tell you how long ago it was, but you've really been in the industry forever. In fact, you were destined for this job. I don't think you wanted to be in it, but you might have been doing approval offer letters under the age of 10. Can you talk to me about that?
Yeah. So I have been in and around the business my entire life. My father was a prolific producer, in his right. He was doing 100 million before that was like a real number. I remember I'm sitting at home on a Saturday or something like that, and he calls home and he's like, I need you to go down to my office and I need you to write an approval letter for me. I'm like 8 to 10.
Yeah.
I got, remember those Macs with like the gray screen? I print it out and then he taught me how to like fax it through the paper at the bottom, on the roll.
Nope.
So I faxed that off when I was like 8 years old. So I did that's why I love to tell that story. It's like,
That's amazing.
did it when I was 8. But yeah, it's not what I wanted to do. I always heard my dad on the phone at nighttime. I didn't want to do that, but I got out of college. The job market wasn't great. And he was like, why don't you come work for Pops for a little bit? And I had already been interning one of his buddies' companies at Mason. I was working in the capital markets, locking loans through fax, which is funny. We're telling the second fax story of the day. It's how much the industry's changed, right?
Yeah, right.
So I went and sort of worked for him, and 21 years later, here we are.
Yeah. So let's talk about that. So you got into it, looking back, you said it's great business. It's great. It's also bad. Well, give us pros and cons.
I mean, the upside is that originators are compensated highly, but you're only as good as your last month and you only eat what you kill. If you want a lot of control on what you do for a daily basis, you can be your own boss. I like to say that I run my own business, but I'm a W-2 employee, right? So the way that is, I have control on how I run my own business within the constructs of the company that you work for. The downsides are, you're on call 24/7 and, you get to the point beginning of your career, I always like to say that you're paid less than you're worth. And then you start getting paid what you're worth. And then you get to the point where you're doing it a long time, you're going to do multiple millions a year before you even, try. People are just at your phone so they keep ringing. So, early in your career, you're living and dying by each individual deal.
Yep.
And it's tough. I asked my dad, Pops, how did you do this for 30 straight years? Like taking calls on Saturday nights and things. He's like, I had to, and that's the thing, but it can be a grind. But there's certain things that I like to try to tweak with my business to kind of keep me engaged and, keep me interested.
How have things changed when your dad was doing it to today? I mean, has it changed much?
I mean, technology's changed drastically. I mean, from the time that I've been in the business and I started right out of high school, instead of going to Beach Week, I went and worked in secondary market. It worked out pretty well. I'm glad I made that decision. All my friends got arrested. But, long story. But it's changed a lot. I mean, just the technology piece, and I'm not talking about pushing originators out of the business. Obviously, you have AI coming, but, loan origination systems, you've got your open finance tools for direct validation through Fannie and Freddie, D1C, those type of programs, but just simple stuff like locking loans. I told you I used to do it by fax, and now, you're doing it. A lot of people are doing mandatory deliveries now through their hedging. The borrower experience is a lot better because we were paperless before the pandemic, but I can't imagine what it would have been like. People were having to get paper during the pandemic.
Sure.
So I just think that, things have gotten a lot faster. The technology tools have made things a lot easier for both the originator, where I can work anywhere at any time. Just even pricing loans, like we used to price off an actual physical rate sheet every day, looking at LLPAs and the pricing adjustments. And now you can give a borrower an accurate price quote for any scenario, multiple of them in 30 seconds from anywhere you are in the world.
So, one thing I was talking with my team earlier, one person was looking to buy, one person just bought. Underwriting guidelines, like the underwriting process. Has that changed much over the years? Like, for example, one thing that was brought up was you can stay in the same industry if you switch jobs, but you don't want to switch jobs. And, has that changed a lot, or is it pretty consistent on what it was 10 years ago?
It's funny. I mean, the pendulum swings one way or the other, right? Like sometimes, typically there used to be a lot of differences between Fannie and Freddie. You go Freddie and then Fannie follows suit. Now it's to the point, where they kind of both mimic each other. But yeah, I mean, one of the things that I was talking about earlier was day one certainty. And you have these tools that you can validate financial source information information through like the work number. Finicity has a tool like VOIE income where you can pull derived income from bank statements.
Yep.
So those types of things, I think, have really changed the process for both the borrower and the producer, because really, I mean, during the pandemic, we were doing refinances where if we had an appraisal waiver, we didn't need appraisal. If we had income verification through like the work number, and then we had asset verification through like open finance, I didn't need anything from the borrower.
Yeah.
And you could close things faster.
That's cool. So like some of those, the verification stuff, I mean, 95% there? Is that what you call it?
Yeah, I
Would
mean,
you
it is
say?
right there. I mean,
Yeah.
it's to the point now where there are some tools online where it's terrifying for people in my seat, right? Where you can go click a button and you know how you get approved for a car loan? Well, I mean, Rocket's been saying that's what they do.
Yeah.
But they don't.
Right.
You're not like single sourcing information to get an actual mortgage conditional approval right then. But for home equity line of credits, they're doing it right now. They're not too far away from first mortgages.
On the note of AI,
Yeah.
what's going to happen down the line? How do you see compensation?
AI is something that, they've been pushing for a long time.
Yeah.
I do think that it moved faster. I think that changes come from necessity, right? And during the pandemic, that pushed a lot of things forward. I don't think that AI is necessarily coming for our jobs right now, but I do think it's going to push people out who do not utilize AI. And so there's a lot of things where they're using AI for underwriting. They want to eliminate kind of the stare and compare of an underwriter looking at things versus like an actual human. They can pick up things and get them conditioned out so that an underwriter can look at it. So you can work with less human underwriters, right?
Yeah.
That's what a lot of companies are doing. Tasks that used to take me 45 minutes, now I can get that done in 3 to 4, and it's a much more polished presentation. But also the coolest thing for me, I mean, inherently we're all human, right?
Yeah.
I tend to procrastinate on the thing that I want to do the least. But if I can figure out the thing I want to do the least to get AI to do it for me, I do it faster, it's more polished, it just makes me look better, quite frankly.
I was listening to a loan officer talk last week about, so after any meeting, they're paying for the ChatGPT plus version, and they're just kind of, hey, here's what happened today in the meeting, here's what I want you to do. And the concept, which I hadn't really heard a ton of, is like you're more talking to it, so it learns you, and it learns what's important to you, and it learns what you typically would like doing. It's kind of frightening, but pretty remarkable also.
Part is that you want to teach your AI about you. You can give it your website. I've had it watch a lot of my social media stuff to know how I speak. It can learn who you are and then respond in a way that you would. Now it still says some stuff that I wouldn't, right? But it's a good framework, a good starting point.
Sure.
So I can be on a phone with a borrower, and then when I get off the phone, like I have something that I can automatically flip out.
Yeah.
It's been a game changer, and I'm just sitting there thinking like, man, I wish I'd done this 6 months earlier.
So, question you get a lot in this industry: when should I talk to my loan officer? I think you got a good story here.
Listen, I think earlier better. You want to get your ducks in a row early. Yep. And so I think a year out, especially for people that have never bought before, or honestly, to the people that own a current home. Like, hey, are we comfortable with this increased payment? Or if you're going from a rent payment to a mortgage payment, right? Yep. Now, the thing is that I say, okay, if you have any apprehension about, a higher payment, well, let's try it on for 6 months or a year, right? So you take the delta between what your rent payment is and your proposed mortgage payment and just practice putting that excess cash in a savings account. If nothing else, at the end of that period, you save some additional money, right? And you know how you feel.
Sure.
Because too many people come to me like, hey, my lease is up in 60 days and they have no idea what it's going to cost or what it takes. And they haven't kind of had time to wrap their brain around like all of these programs, like what these things mean. Like, hey, I actually have to I can't be late. Like there's a lot to it.
Yeah, sure. Do you prefer having taxes paid within the mortgage payment or separately, one way or the other? Do you have any thoughts on that?
I mean, I've done both.
Yeah.
Some programs require that you escrow.
Yeah.
Like typically if you're putting less than 20% down, you have to escrow. I'd rather just set it and forget it, honestly. I escrow for all mine. Now I deal with the escrow shortages. I mean, if I was had an interest-bearing account that had like 10% interest, like sure, I'd rather have it. But I'd just rather not have another bill that I have to worry about.
I currently am paying taxes on the side. I don't like it.
Well, and that's the thing. If you are if you know yourself, sometimes you have to protect yourself from yourself.
Exactly.
So yeah, I mean, I see both sides of it. One thing is, I've learned to never argue with a client about it. Whatever they want is right.
Whatever you want. 100%. You talked about car loan. So I just got a car loan, did it online, never spoke to anyone, money came in my account the next day. It's amazing. What about compensation in your industry? Like I've heard people be like, oh, you guys make so much money. But then I've had other situations, such as the last couple of years, where people are like, loan officers don't make anything. They deserve whatever they get, whatever they hunt to kill. With AI, with automation, do you see compensation changing at all or not?
You know, it's an interesting question, especially right now. You know, everything that's going on with the CFPB. Like, they'd have to repeal Dodd-Frank, and that literally takes an act of Congress, not like the proverbial act of Congress. You know, a lot of loan officers, they say, you know, I'd rather go back to the old days where I can get overages and such. But I don't know that that's a good thing because of technology's advanced so much. For a company, that would be great because you can pay directly on the profitability of the loan. For a mortgage originator, like, there's going to be people in other areas of the country that are like, hey, that's $1 million loan in Washington, D.C. I'm happy to make 10 basis points on that, right?
Yeah, sure.
Most people in the D.C. area do not work for 10 basis points.
Yeah.
They work for a lot less than, you know, some of the counterparties in the South. But I think that would overall probably be bad for the mortgage originator. And you know what? We have so many market intelligence tools now that we can look at. We can see where everybody else is priced through Optimal Blue. I don't know that it's going to change, and I don't know that it's a good thing anyway for the originators at least.
So I watch your TikTok. Are you on Instagram also?
TikTok?
You're on TikTok. Did you know that? Are you on any other social media platforms besides TikTok?
The big one that Instagram is like, that's the one I actually know how to use pretty well.
Okay.
But I do have some help in my social media. It's all me, you know, I don't necessarily come up with all the content. It's not something I hated it at first. I mean, I did. It's cringeworthy, but found out like one of the things that, you know, be doing this for so long, like first you have to be good at your job. I think it's an important part. You know, I do. It's social proof.
Since you were one of the first people I think I followed on TikTok because I'm not really ever on it.
Dude.
So I get the little alerts. Oh, Pyne has a new video. And I'm like, ah. But no, you do a good job of bringing up, in my opinion, it's the questions I would ask if I was getting a mortgage. You know, and so the other thing I think you're good at, and you know, I kind of talked a little bit about this, but like the normal consumer out there really doesn't understand, like, why does inflation matter? Why does the unemployment rate went down? Why is that bad for rates?
Right.
Do you mind giving us a little one-on-one on some of the important factors in the economy?
Well, one thing I'll preface this with, I'm not an economist, right? But the thing is that I understand how some of the economic factors impact our business. Real high level. Typically when unemployment is high, interest rates are low. So a lot of the things that we look at non-farm payrolls. And so what that says, they have an expected amount of jobs that are added. When that number comes in higher than the mark, it says the economy is rolling, interest rates are typically going up. So we're always looking at that. It's a weird dynamic that we're rooting for the unemployment rate to go up in this country for interest rates, right? But that's the way that it's always been. Then you look at like CPI, which is Consumer Price Index. It's like a good measure of inflation. Inflation, when it's high, not good for rates. That's what's going on right now. You know, our boy Jerome Powell is printing money during the pandemic. Like, that's my favorite coffee cup. I got a Jerome Powell with like money guns shooting money up in the air. Yeah, you know, like it was great for us at the time, but now we're paying the piper for it. So we need to get inflation back under control. And once that does, interest rates should go down. But I think it's important too, like you can look at a couple different markets, right? Like I tend to look at unemployment rate, consumer price index, non-farm payrolls when those come out. But also too, like if you're just trying to follow the trend of interest rates, follow the 10-year Treasury. That's what I tell people.
Tell people that's in your Treasury.
This is what I tell people because, like, especially in this market, right? Everyone's concerned that, hey, what if I lock my rate too early? Well, you should be working with a lender that has float down and all this too, right? Someone's have different rules for it. But rather than call me and ask about the rate every single day, just follow the 10-year Treasury, right? 10-year Treasury goes up, right? Rates are going up. 10-year Treasury goes down, rates are going down. But rates go up faster than they go down.
So I was watching one of your videos recently, and you had mentioned that, you know, hey, these are where rates are at that time. This was a couple months ago. It might have been around 6.5. I don't know. It's probably not too far off. But you'd mentioned that, you know, some of the first-time home buying programs, you can get, you know, into the, let's call it low to mid-5s. You know, what is the process for the first-time home buyers to, you know, be eligible for those programs? How much more work is involved? What does that look like?
Well, I mean, that's the thing is that when I first started in the industry, people call them like, what's your rate today? And the loan level pricing adjustments, like that's basically how we price loans in our industry is based on risk, right? Simple way of talking about it is that the higher the down payment and the higher the credit score, the lower the interest rate because the lower the risk on the loan. The lower the credit score and the higher the loan to value or the lower the down payment has a higher percentage of default, therefore higher interest rate. Got to get some more yield. Now, so you got to get like 15 data points, not 15, but probably like 5 to 6 data points so you can give an accurate rate quote. Down payment, loan amount, are they above the conforming loan amount? Are they not? But for first-time home buyers, it's a little bit more complicated because most of the first-time home buyer programs are income-based. In our area, the average area median income, like you basically have to be below $160,000 to qualify for that. But then if you're below 80% of the area median income, there's an additional rate adjustment where you get like through Fannie's Home Ready or Freddie's Home Possible programs. And then you've got like CRA products, which some of those, I mean, they're about 1% underneath the market. And those are based on where the property is. Okay.
What does CRA stand for?
With the CRA products, those are based on census tracts. So basically you pull the address in, and if it's in a low to moderate income area, you get different options. Like banks have to invest in those areas, so they offer a lower interest rate to take in some of that. It's really popular here in DC where we're sitting right now. Some other areas that you see it, Arlington County, Alexandria, some in Reston. So, and also higher percentage of minority residents is where you see some of those products be available. But some of those products don't have mortgage insurance. You can put 3% down, no MI, up to an $806,000 loan amount.
Yeah, because I was going to say, like, is a first-time home buyer, is that less risky or more risky? But you're saying it's more that the banks have to invest in certain areas, and that's why.
And that's the thing. For those products, the CRA products,
a
lot of them you don't even have to be a first-time home buyer. You just can't own any other property.
Gotcha.
But for the first-time home buyer loans, like we're going to ask a multitude of different questions and put them into one bucket. Are we going to look at like first-time home buyer grants? Do they make enough money, or do they make too much money to qualify for those? And where the property is located versed on like, hey, are they in Fairfax County? Can we use Spark funds? I mean, there's a bunch of different things. And so what you really kind of have to do is get a loan application in, get them pre-approved for all of these things. And then what I think is the best thing to do is to run numbers on 4 or 5 different properties for them, different price ranges, show them cash to close, show them what their monthly payment's going to be, because like something goes on the market, it's pending in 24, 48 hours.
Sure.
If people like haven't seen numbers before, then they haven't had time to digest the data. Then if they have had time and they're comfortable, then they can move quickly. And that's going to help them be more successful in a multiple offer situation.
That makes a lot of sense. You mentioned 160,000. Let's say there's a married couple, it's young. Is it combined income, or would you just, how would that play?
Well,
could you have one person qualify?
Yes, you can. You can not count income for one person. If one person is a first-time home buyer and the other person isn't. So that's the thing. Like, we want to get everything together and start peeling back layers of the onion, right? So, like, hey, one person owns a house, like take them off the loan app and put one person on as long as they qualify for someone's income. It's basically the same thing as like, hey, if you can qualify of one income and someone has a lower credit score, and that's because mortgage loans are based, most of them are priced based off the lowest common credit score on the loan. Some are priced off the wage earners, but if you can take one person off and they get a lower rate as a result, why not do it?
Let's go back to the beginning days of you getting in the industry. So, people coming in the industry now. First of all, do you think it's a good time to come in or bad time?
No, I don't. I think the barrier to entry has never been greater. For the most part, since I've been in the industry, we've been in a declining rate climate. Now, if you look at it, look at the stats of how many loan officers are actually in the country right now, like licensed people that renewed. I think it's down to like 80,000.
So versus what was it?
Like 400,000 to 500,000.
Yeah. Okay. Wow.
So
significant.
It's a huge drop off, right? But what do they always say? That the weather after a storm is always the best weather, right?
Sure.
So like when things do turn around for the people that are left, and it's all the grizzled vets. You look around, it's all the people that you've seen in the business for 10, 12, 15 years. I think there's going to be some really good conditions, but in order for things to really start moving, I think that rates have to get into like to the 5s. I can sell a 5 handle, like, because that's pretty close to where we were pre-pandemic.
Sure.
And we all had great years in 2019.
Right.
I also think that some of the servicers have gotten really good at retaining their book, where a lot of them are reaching out right now and they're proactively giving modifications. Right. Or, I mean, shoot, you guys know if you're ordering payoffs, loan officer's like, don't order the payoff until 24 hours before closing.
Sure. Exactly.
Well, why is that? Because they're going to offer them a mod, or they're going to refinance them themselves.
Exactly.
So I think they've had 4 to 5 years to protect their portfolio. So the conditions were so ripe for it. Like, I just don't think we're ever going to see a refi boom like we did. Not just because of rates, but because the servicers have gotten so good at holding on.
Makes a lot of sense. Do you think the old adage, date the rate, is dead?
I hate that.
I mean, I hate it. I think a lot of people hate it. I haven't heard it in a while.
I have heard it.
Have you?
Yeah, and it just kind of made me feel kind of gross. I think basically you can talk about the cost of waiting, which is real. Even if you wait for 2 years till rates come down, prices are going to go through the roof when rates go down, because rates have an effect on affordability, what people are willing to spend. Then you've also got standard appreciation. So if rates go down 1%, right, and property values go up 8%, your payment's still going to be more. And your out of pocket's going to be more. Right? But the point is that if you have to feel comfortable with the mortgage payment, like if you're comfortable with it, but it can only go down from there, great. But if you're stretching and you don't feel good about it, don't do it. For those people that maybe didn't buy during the pandemic, unfortunately, the conversation is that you might have to adjust your expectations a little bit. You look at what a $5,000 mortgage payment got you during the pandemic, and you look at what it got you now, it's drastically different.
I mean, and look, I'll even say for myself, I did a little house renovation. When I got my HELOC, I think it was at 4%. Now it's 8.5%. Well, that's the way it works.
Yeah.
Do I have the same amount of HELOC payment as I do? I'm pretty sure I do, but it is what it is.
Yeah.
People are like, oh, well, if rates go to 5, the floodgates are going to open. Well, okay, maybe, but that's still double the rate I have, ish.
Yeah.
Right? So, like, that's something to consider, which is like, okay, that's a good rate.
Sure.
Now, don't get me wrong, there's people over the last 3 years, which it's better. But, like, I also wonder that, too. People that are locked into, I'm going to say 2.5 to 3% for 30 years, do they ever leave?
I think there's going to be a lot of people that become like landlords as a result. I think people are going to start holding on to properties like they wouldn't because, I mean, listen, if you think about it, right? And I've kind of talked to a couple different clients about this where the cash flow on their previous property, if they turn it into an investment property, will help supplement, the increase for the next one.
That's actually a really good point.
But also, too, would they be able to be at the same level if they just sold the property and rolled the equity over? That's the thing. But I don't think there's a wrong answer.
Yeah, no, I agree with you. That's a really good point too. Which is, so I mean, that is good if you can get people to be like, "Hey, I'm never leaving this rate. I'm going to keep it. I'm going to rent it out." Then maybe there's a little more activity than I was even thinking. Because sometimes I'm thinking like, no one's ever going to leave, so the activity is going to be low forever.
Well, I think what it is that we had a podcast, or not a podcast, like a webcast with Barry Habib, and he said for every 1% decrease in rate, it adds 1.9 million buyers.
That's interesting.
Right, it is.
Yeah,
but it's like, why is that? Well, it's because a lot of people. Some people have to move. Family size changes, they move to different areas. And some people just can't afford it with where interest rates are.
Right.
So we've been lucky in this area where, we have the federal government changes over every 4 years and people are coming in and out of the area for Amazon, those types of companies. So our local economy is usually a little bit stronger. We've got people that are coming back to DC that moved out during the pandemic to Charlottesville, West Virginia, Fredericksburg. I've had a lot of people that we've done loans for that are moving back to the area because of that.
Right. Top mistake to avoid when applying for a mortgage?
I would say that changing jobs, it can be tough.
What if you're changing the same industry? Does it become a problem or not?
Maybe.
Yeah, it could be, right?
Because people
I'd be a little nervous. I'd be nervous if I was an underwriter.
Yeah, well, because bonus income. What if you have like someone that has variable income, such as bonus or commission? Well, they switch up. Oh, yeah, but I got a guarantee for a year they're going to pay me X amount. Well, in our industry, you have to have 36 months of continuance.
Yep.
Right? So I always say, always vet job offers with your loan officer like well ahead of time.
What's the best advice you've given a young couple who's buying their first home?
I think going back to what we said earlier, like, hey, we're talking early, practice making the payment, right? Because listen, debt to income is like the metric that we use to qualify people.
Yep.
But also, too, I can look at someone's bank statements and see how they live their lives, right?
Sure.
People like to travel, like to go out, like to eat fancy and stuff. Some people like it's a game for them to save money.
Yeah.
So some people like, hey, you can go all the way to 45%. Some people like, hey, if we put them at 45%, they technically qualify, but they're going into debt at their current housing payment. I don't want to talk people out of buying a house. But at the end of the day, like, you got to show them the numbers.
Yeah, that's a fair point. Biggest myth about mortgage lending you'd like to debunk?
I feel like we got penalized a lot during, what happened with the mortgage meltdown crisis.
Yeah.
It got called mortgage meltdown crisis.
Sure.
The big banks on Wall Street, they were the ones that were issuing these
Right?
programs.
Yeah.
You know what I mean?
Yeah.
And a lot of companies,
a
lot of companies were like, hey, we don't really want to do these products. And then everybody else doing it. So if you can't beat them, you had to join them.
Yeah,
so there's a lot of that going on. And executives in my walk of life at that time were losing producers out to other companies that were doing it. Some of those products did make sense, but a lot of them didn't. You had gas station attendants called petroleum distribution specialists making $120,000 a year, right? If you had a self-employed guy that you did stated income for that, just maybe his tax returns were a little bit more off, it did make sense. But I think that's really it. It wasn't necessarily all our fault.
Yes.
Partially our fault.
The worst loan during those times, would it be the neg amp? Is that what they call it?
Yeah.
Right?
The neg amp.
So the loan is increasing over time? Is that what it was?
That's exactly, well, right. So the principal that you didn't pay was tacked onto, or interest you didn't pay was tacked onto the loan. Yeah. So it just kept getting bigger and bigger.
So it's just assuming you're going to appreciate a very high amount.
Exactly.
Yeah.
Well, that's the thing. There were some cool programs back then. Like, I wish we had this one too, like readily available. It was a 30-year fix with a 10-year interest-only period, which for loan officers is great, right? You have what you call lumpy income. So during the spring and summer, when you make 70% of your income, push your mortgage down. But in the other months, if you just want to make the interest payment, do it.
Ideal credit score range for a smooth mortgage process. Is there a number where you're like, man, I really want you over this number?
I mean, they changed that a couple of years ago when FHFA changed the loan level pricing adjustment matrix pretty significantly. I mean, I would say that magic number is like 740 for conventional financing, but for now it goes up to you get better pricing above 760.
Okay.
And then jumbo, it's over 800. If you want the best rate, 800 scores for a loan amount above 806, 500.
Highest score you can get is 850?
850, yeah.
Is that it?
And everyone, I mean, listen, lenders know this. They're like, hey, they call me like, I got an 840 score. No, you don't.
What is the highest you've seen?
The highest I've seen is like an 830.
Okay.
And this dude was probably in his late 70s, early 80s, and had an Amex open for like 40 years. You know what I mean? Like,
yeah, paid every year on time, every month on time.
That's the thing. Credit's a funny thing.
Yeah.
I was actually talking to my father-in-law about it this past weekend. He's like, I see my credit score keeps going down. I'm like, that's crazy, right? He's like, yeah, I don't have a mortgage.
Yeah.
I have one credit card. I pay everything most in cash, but that's called thin credit.
Because he needs more credit.
That's right. Because the thing that helps your credit scores is by having a lot of available credit that you're not utilizing.
Mm-hmm. Yeah.
Right?
Yep.
So someone who may have $10 million in the bank and doesn't have a credit card and pays everything cash, like they can't get a loan. It's kind of crazy, right?
Yeah, it is nuts. Yeah. There are still times I hear where it's like, oh, it's hard for me to get a loan. I mean, I would think by now with like AI and automation and underwriting upgrades that would not be a thing anymore. Is that going to go away, in your opinion? Like, why can't some people be like, the guy has tons of cash. Why would I not take this risk? What's your opinion on why that is?
Well, I mean, really the thing is that we have like the ability to repay rule, right? Mm-hmm. And that's like where non-QM comes in. So like if you want a QM loan, we've vetted income that comes in. And sometimes people, their income isn't as straightforward as others. Like if you're a W-2 employee, your salary, like you have bonus income, you're doing an average. Self-employed folks, that can be a little bit more difficult because, well, one, when do they file their taxes? Have they not? Right? Are they on a return? Do they have K-1s? Do they own 25% or more of the company? If so, then we need their business returns.
Sure.
So it can be chasing a rabbit down a hole at some point.
Yeah.
But at the same time, like those are the rules that we're given.
Yeah.
You know, and everyone follows them to the most part. One thing I will say that has been a really nice recently is we do a lot of jumbo financing in this area. And a lot of the jumbo products have adopted following Fannie and Freddie's AUS products.
Right.
So that's great. Gives you some relief because, you know, there will be some overlays, but you know, sometimes you can do 1 year tax returns on a jumbo loan, which was unheard of. It's a true manual underwrite. You don't need to track down a VOR, verification of rent. So that has been really nice. But what I will say is that for jumbo loans, there's like A+ paper, A- paper, and then B paper. Like it's all interest rates. So if you want the best rate, it's going to be the most stringent underwrite. You know, it's going to have the highest credit score, a pretty good loan to value, 20 or 25% down, and then you're going to have a lot of cash reserves. That's how I kind of explain people that are buying jumbo is like, hey, you can do this and get this product, or hey, we're going to have to qualify for this product, which means a rate differential.
Yeah, makes a lot of sense. Conforming, non-conforming rates, where are we at? What are the limits at these days?
Conforming is 806,500, and then it's 150% of that for the high balance loan, so it's like 12975, right?
Okay.
Know what it is?
Yeah. I mean, I have no idea.
Yeah, dude, I feel like it takes me until probably like May until I can like spit it out. Things like that, high balance. But we put so many people into the jumbo products these days because the conforming high balance product pricing is just usually not as good as the execution for jumbo.
Hey, bud, I appreciate you coming on.
Yeah,
it's
dude.
great seeing you
Yeah,
as always. Yeah, you're the best.